Hello everyone, Kasim Khan is here. Please subscribe my channel and press bell button for more updates. So guys, thank you so much for watching my video. And today we are going to do a part 3 of risk and return. That is chapter number 5 in Van Horn book. And the topic of today's lecture is CAPM, that is Capital Asset Pricing Model. So what is CAPM? CAPM is a model that describes the relationship between risk and expected required return. In this model, a security expected required return is the risk-free rate plus a premium based on the systematic risk of the security. So here is the equation which we use for the calculation of CAPM, capital asset pricing model. Here is RJ. RJ is the expected return for security J, that is equal to RF. RF is risk-free rate plus BJ. BJ is the systematic risk, that is known as beta. Beta j into Rm minus Rf. Rm is the required return on the market, minus Rf is risk-free rate. Basically, this is your risk premium which you get above on the risk-free security. So with the help of this equation, we can calculate the expected return of any security in the CAPM model. So first we need to explain and first we need to know about what is beta. A beta is an index of systematic risk, and you know what is systematic risk. Systematic risk is undiversifiable risk, that risk which is not associated with your organization, and this risk is uncontrollable risk and undiversifiable risk. So beta coefficient are relative measure of non-diversifiable risk, an index of the degree of movement of an asset return in response to change in the market return. So basically, beta is the degree. Beta is an index that determines the degree of movement, how much there is a change in asset return in response to change in the market. So if there is a high beta, then there will be high degree of movement, and if there is a low beta, it means your uh, response rate and the change in return of your asset is less as comparative to the market return. So market return, the return on the market portfolio of all traded securities, that how we find out the market return, that is the return on the market's portfolio of any kind of securities. All traded securities are the part of market portfolio, and the return of market calculated on the basis of market portfolio. So what is beta? What are the interpretation of the beta? Interpreting beta, the beta coefficient for the market is considered to be to equal 1. All other betas are viewed in relation to this values. Generally, we assume that the market beta is equal to 1. So we check the relations of all other beta with the perspective of 1. Asset betas may be positive or negative. The range of beta is between -2 to 2. So the return, here is the illustration of this concept with the example. Let's suppose the return of the stock that is half as responsive as the market, beta 0.5 is expected to change by 1 by 2% for each 1% change in the return of the market portfolio. Basically, this is the meaning of this. If there is a change, if there is a 1% change in the return of the market, then the return of your security will be changed with 0.5%. That is 50% change will become in your security. आज अगर मैं इसको आपको सिंपल वर्ड्स में बताऊं कि आपका जो बीटा होता है ये बताता है कि आपकी मार्केट का जो आपकी जो एसेट है या सिक्योरिटी का है उसका रिस्पॉन्स रेट मार्केट के रिटर्न के साथ कैसा है। तो लेट्स सपोज हियर इज द बीटा ऑफ योर सिक्योरिटी 0.5। तो इसका मतलब ये है कि अगर मार्केट में 1% रिटर्न इंक्रीज करेगा तो आपकी सिक्योरिटी का रिटर्न 0.5 परसेंट इंक्रीज करेगा। इसी तरह अगर आपके मार्केट के रिटर्न 1% डिक्रीज करेंगे तो आपकी सिक्योरिटी के जो रिटर्न्स हैं वो 0.5 के साथ डिक्रीज करेंगे। तो बेसिकली बीटा जो होता है वो रेट ऑफ चेंज डिटरमाइन करता है of your asset return with the perspective of market portfolio return. So a stock that is twice as responsive as the market, let's say beta is 2, is expected to experience a 2% change in its return for each 1% change in the return of the market portfolio. Let's suppose if there is a beta of your security is 2, so at that time, if there is a 1% change in the return of market portfolio, then the change in the return of your asset and security will be 2% higher as comparative to market. अगर मार्केट के रिटर्न 1% के साथ इंक्रीज करेंगे तो आपकी सिक्योरिटी के जो रिटर्न है वो 2% के साथ इंक्रीज करेंगे. अगर मार्केट के रिटर्न 1% के साथ डिक्रीज करेंगे तो आपके 2% के साथ decrease करेंगे. The responsive rate is double as comparative to the market. So here is the range of betas -2, -1, -0.5. These are the negative betas. 0 is the medium level, and then 0.5 to 2, that is positive beta. So when there is a positive beta of your security, at that time move in the same direction as market. At that time returns of your security will move in similar direction of market returns. And let's suppose if there is a 2 beta of your security, at that time twice as responsive as the market. अगर मार्केट के रिटर्न 1% इंक्रीज करेंगे तो आपकी सिक्योरिटी के रिटर्न 2% इंक्रीज करेंगे. द लेवल विल बी डबल. So if there is a beta 1, at that time same response as the market. अगर मार्केट की रिटर्न जिस तरह इंक्रीज करेंगे जितनी अमाउंट के साथ आपकी सिक्योरिटी के रिटर्न भी उतनी अमाउंट के साथ चेंज होंगे, इंक्रीज करेंगे. इसी तरह 0.5 only half as responsive as the market, unaffected by the market movements. If there is a move in when there is a negative beta, तो आपकी जो सिक्योरिटी के रिटर्न्स होते हैं दे मूव इन अपोजिट डायरेक्शन टू द मार्केट. अगर मार्केट के रिटर्न्स इंक्रीज करेंगे तो आपके डिक्रीज करेंगे, अगर आपके मार्केट के डिक्रीज करेंगे तो आपके इंक्रीज करेंगे. बेसिकली आपकी जो एसेट की रिटर्न्स की मूवमेंट है दैट विल बी इन अपोजिट डायरेक्शन टू द मार्केट रिटर्न्स. अगर आपके 0.5 बीटा है माइनस में, ओनली हाफ एज रिस्पॉन्सिव एज द मार्केट, and in -1 at -1 same response as the market, and -2 is twice as responsive as the market. So these are the movement and the rate of change in the response of the market. So what about the portfolio beta? We were talking about the individual security beta. So at the time of portfolio, the beta for a portfolio is simply a weighted average of the individual stock betas in the portfolio. Portfolio betas are interpreted in the same way as the beta of individual assets. They indicate to the degree of responsiveness of the portfolio returns to change in the market returns. पोर्टफोलियो के बीटा कैलकुलेट करना भी मुश्किल नहीं है. सिंपली वी टेक द वेटेड एवरेज ऑफ ऑल इंडिविजुअल स्टॉक विच आर द पार्ट ऑफ पोर्टफोलियो. जितने ज़्यादा हमारे एसेट्स होंगे पोर्टफोलियो के अंदर उन सारे के इंडिविजुअल बीटास की हम वेटेड एवरेज ले लेते हैं. And the interpretation of the portfolio beta is similar to the individual asset beta. So for example, when the market return increases by 10%, a portfolio with a beta of 0.75 will experience a 7.5% increase in its return. और जो हम ओवरऑल पोर्टफोलियो का एक बीटा फाइंड आउट कर लेते हैं एंड उसका जो रिस्पॉन्स रेट होता है दैट डिपेंड्स ऑन द परसेंटेज ऑफ द पोर्टफोलियो बीटा. So here is the equation which we will use for the calculation of expected return using the beta coefficient to measure non-diversifiable risk. The capital asset pricing model is given an equation Rj is equal to Rf plus beta j into Rm minus Rf. Rj is the required rate of return for the stock J. Rf is the risk-free rate of return plus beta j is the beta of stock J that measures systematic risk of stock J, and RM is the expected return for the market portfolio. This is the market premium. This is the market portfolio return which we will expect. So here is the graphical representation of security market line that is also known as SML. On the vertical side there is a required return, and on the horizontal side there is a systematic return. and this is the risk-free rate. This is risk-free return. This return is expected by every investor, every by on every investment by every investor and the stockholder. So here is basically the SML, and this part is the risk premium, and the above any point above this line is the risk premium, and as you move above on this line, you will get higher return, higher market, high risk premium. So here is the beta, that is a systematic risk. So Rj is equal to Rf plus beta into Rm minus Rfj. So this is the graphical representation on SML line. So here is an example for illustration of this concept. Lisa Miller at Basket Wonder is attempting to determine the rate of return required by their stock investors. Lisa is using a 6% RF and a long-term market expected rate of return of 10%. A stock analyst following the firm has calculated that the firm beta is 1.2. So what is the required rate of return on the stock of Basket Wonder? Here are some information about the investment plan. The first one is RF is 6% and the market expected rate of return RM is 10% and the beta of the firm is 1.2. So what is the required rate of return on the stock of Basket Wonder? R bar BW is equal to RF plus beta J RM minus RF. So we will use this equation for the to calculate the required return. BW is equal to 6% plus 1.2. 10% is our market return minus 6%. So R bar BW is 10.8%. So the required rate of return exceeds the market rate of return as a BW beta D beta exceeds the market beta 1. Because our beta has been increased by 1, so that's why our return has been increased by the market rate of return. So thank you so much for watching my video. It was all about the concept of CAPM, capital asset pricing model. And thank you so much. If you have any question, you can ask in the comment. I will really feel good to answer your question. Thank you so much. Stay happy, stay blessed. Bye bye.